Investing isn't always fair. Some investments are for the select few. Globally, people who have a net worth over $1 million control 45.8% of the world's wealth. In the US, there are 22 million adults who have a net worth over $1 million. And that may seem like a lot, but to put it in perspective, that's only 7% of the US adult population. These chosen few have access to investments that other people can only dream about. Let's get into it. So let's start by talking about Ashley Revell. So at the age of 32, he took his life savings and traveled to Las Vegas and bet his entire life savings on red on the roulette wheel.
Okay, red.
Good luck.
If this sounds speculative and crazy, it absolutely is. There are no safeguards in place from someone betting their entire life savings in a single moment. But if you wanted to take your entire life savings and invest it in a startup like OpenAI, one of the hottest new AI companies in the world, you can't. The Securities and Exchange Commission deems you as an investor with limited financial knowledge, and they need to protect you from risky ventures that you would be ill-equipped to withstand losses from. So in order to become an accredited investor and actually invest in what you want to invest in, you have to meet the following criteria. So as an individual, your income needs to be over $200,000 a year. And if you're married, your joint income has to be over $300,000 a year for the past 2 years, or you need a net worth of over $1 million. And in 2020, they added a few additional criteria that make accredited investor status more accessible. So if you are certified in Series 765 or 82 licenses, which are all financial industry licenses, they consider you a knowledgeable investor and give you accredited investor status. But you could also be a knowledgeable employee of a private fund or a state registered investment advisor, and that would also qualify. So a capital stack is just the hierarchy of debt and equity on a company's balance sheet. And it determines the order that people get paid out in if the company goes bankrupt. So in the capital stack, at the bottom of the stack, you have your senior debt, and then above that, you have your mezzanine debt, and then you have your preferred equity and your common equity. So the best way to think about this is as you move up the stack, you have a higher potential for reward, but your risk goes up. And toward the bottom of the stack, your potential for reward is lower, but your risk is also lower. So if you have debt in a company, they're going to pay you back that amount with interest every single month. If the company is performing well, it doesn't matter. They're still going to keep paying you back the same amount each month. If you have equity in a company, you only really get paid back if the company performs well. So if the company is not performing well, you get very little return on your equity and the value can actually go down. But if the company 10x's or 20x's, then whatever you invested is going to 10x or 20x. And this brings me to the investment type that is only available to accredited investors. It's called a convertible investment. So essentially, a convertible investment allows you to buy bonds, which are debt in the company, and at a set price, convert it to common equity, so a common stock in the company. So you can assume a position of low risk, and if the company is performing well at a predetermined price, convert it into equity. And these type investments are only available to accredited investors. So it's a no-lose scenario where if the company goes under, you still have a preferred position in getting paid out. And if the company is performing well, you have a preferred position in getting a large equity stake in the company.
Nice.
Private credit is another investment that is only available to accredited investors. So if we revisit this capital stat, this is the mezzanine debt. So essentially, private companies need to take on debt to grow their business. And this private credit industry is $1.4 trillion, and it's expected to grow to $2.3 trillion by the year 2027. So you can invest as mezzanine debt in a company and lock in lower risk returns with that company. You won't have the option to convert it like you would with a convertible investment, but these private credit investments give you a much larger return than you can get with traditional bonds and debt-based investments. Something that's very similar to this private credit option are hard money loans and private lending. So instead of lending money to a business, you're lending money to a person. So for hard money loans, a lot of times you're lending the money to real estate investors who just need money over a short duration to complete a rehab or a fix and flip on a property. And then they return that money to you at a much higher interest rate than they would get with traditional financing. So the trade-off is you have to do your due diligence on the person you're lending money to, what they're actually going to be using the funds for, but you can get a much higher return with private lending and hard money lending than you can with a lot of other debt-based investments. So venture capital and angel investing allows you to buy in the early stages of a company. Ryan Reynolds, Mr. Deadpool himself,
Captain Deadpool. No, just Deadpool, yeah.
He invested in the early stages of Mint Mobile and Aviation Gin. He provided his likeness to grow the business, and then he was able to sell at a much later stage for $350 million. So this early stage investing in companies can have an outsized return on your profits. So Steve Ballmer is another example of this. Steve Ballmer was a 30th employee for Microsoft, and he joined the team in June 11th of 1980. When Microsoft incorporated in 1981, Steve Ballmer had an 8% ownership share of Microsoft. And he's now the owner of the Clippers, and his net worth is over $125 billion. And it's all due to his early stage investing. So private equity is often confused with venture capital, but the biggest difference in this strategy is that they're investing in companies that are much later in their life cycle. So they're investing in mature companies, and instead of banking on the potential growth of the company, they're assuming that they can streamline inefficiencies in the business itself and increase the profit margin. So in 2000, private equity firms managed about 4% of all US companies. And by the year 2021, they managed 20% of all US companies. So to put that in perspective, the private equity market has been growing at 5 times the rate of the US market as a whole. The private equity industry is kind of a shadowy hand controlling the US economy. They have very large investments in infrastructure and energy spending, and dialysis, veterinary clinics, and other businesses are heavily controlled by private equity. In fact, there are real estate private equity funds that control large swaths of the farmland in the United States. So let's talk about the Medallion Fund. So the Medallion Fund has made a 62% every year over the past 3 decades. And if you compare that to the S&P 500, which only made 11% a year over that same time frame, it is a big difference. So to put it in perspective, $1 invested in the S&P 500 from 1988 to 2021 would turn into $40. If you invested that same $1 into the Medallion Fund, your $1 would be worth $42,000. So this Medallion Fund is called a hedge fund. It is by far the most successful hedge fund of all time. And they've been closed to investors since 1993. If you want in on the Medallion Fund, you need to be a Renaissance employee or a family member of a Renaissance employee to get in. But these are the type returns that are possible with hedge funds. And the reason they can get these outside returns is because they are not as tightly regulated as traditional funds, and they can engage in exotic trading strategies using derivatives, shorts, options that are not accessible to a traditional fund manager or ETF manager. I'm sure you're thinking, well, I'll just get the next best thing to the Medallion Fund. And the answer is there really isn't a next best thing to the Medallion Fund. Most hedge funds don't actually see those kind of returns, and that's not even actually their goal. Their goal is to give you returns that are not correlated to market conditions. So they're trying to get the beta of their portfolio as close to 0 as possible. So they want no correlation with the underlying market and to give close to or slightly above market returns. And as long as they don't lose money when everyone else is losing money, most people who invest in these hedge funds are happy. And the other big drawback of investing with a hedge fund is that the initial investment is very large. So we're talking between $100,000 to up to $2 million minimum to even show up as a potential investor in a hedge fund. And some hedge funds have much larger minimum buy-ins than that. So imagine owning the entire music collection of Michael Jackson, Justin Timberlake, Bruce Springsteen, Red Hot Chili Peppers, or Shakira. So all these artists have sold the back catalog of music and any royalties that they're going to receive from it. And as an accredited investor, you can buy into the royalties for music, books, TV shows, oil, natural gas, minerals on a property, and you can get recurring revenue from these royalty funds. The biggest drawback to a royalty fund is that a lot of them have very high minimum investments. So some royalty funds, the minimum investment can be $5 million. But if you're trying to create recurring revenue with money that you've generated across your life, you could do worse than owning the back catalog of Michael Jackson. So a lot of people don't necessarily think about art as an investment, but the wealthy have for a very long time. I'm sure if you go to any local museum, you'll see that a lot of the work on display is lent to that museum from someone's private art collection. And that's to increase the value of their art. On average, art is returning 14% year over year, which is actually outpacing the S&P 500. And there are a couple platforms which you can actually buy into fine art funds. So if you go to Masterworks, they let you buy into a fine art fund and grow your money. I mean, if you're balling out of control, you could always go to Sotheby's and buy the art directly, but that's on you. So real estate syndications allow accredited investors to pool their money to buy much larger real estate assets than they would be able to buy on their own. So you can buy into all types of commercial real estate assets. So hospitals, grocery stores, strip malls, large apartment complexes. And by pooling your funds together, you can buy in and get outsized returns that wouldn't normally be accessible to you. People who take part in these real estate syndication deals generally get a boost in their income from the syndicator boosting income on the property, but they also get a bump in equity on the property, because the way commercial real estate works is that as the income of the property increases, so does the value of the property. But they also get very large tax benefits because of the depreciation on these commercial properties and the cost segregation studies that can be done for commercial real estate. So private real estate investment trusts, unlike their public cousins, actually get a higher return. So private real estate investment trusts yield between a 7 to 8% return, where public real estate investment trusts usually get 5 to 6. The biggest difference is that these private real estate investment trusts are not marked to market, so you don't get real-time updates of what the overall value of that real estate investment trusts are, but there's lower volatility and you get these higher returns. So interval funds are required to distribute any capital gains and income to their shareholders. And unlike a regular fund where you have daily opportunities to liquidate, interval funds only allow you to liquidate on a set schedule. So either quarterly or semi-annually. And the fact that the liquidity is lower allows these funds to invest in more illiquid investments that have a higher return potential. So interval funds are a good balance of risk and liquidity that you cannot get with a traditional mutual fund. So these are some of the many investments that are only available to accredited investors. These are not the only tiers of investing. There are actually 2 more tiers of investor status. So being a qualified purchaser, so if you have 5 million in investments, or you aggregate 25 million in investments from other qualified purchasers, then you are a qualified purchaser. This allows you to invest in some very specific SEC investments that are generally limited to 100 investors. So there are some private real estate deals that require you to be a qualified purchaser to actually invest. So the tier beyond being a qualified purchaser is being a qualified institutional buyer. Only a legal entity can be a qualified institutional buyer, and you need to manage $100 million in securities to qualify. And once you reach this qualified institutional buyer threshold, the SEC no longer deems you requiring protection, and you can pretty much do whatever you want. So there you have it. Those are some of the investments that are only available to the elite few. If you cross this threshold into being an accredited investor, no one sends you some sort of welcome card in the mail. You're not going to get an email spelling out what being a member of this club entails and what you can do with this newfound ability. And consolidating all this information in one place is something that I wished someone had told me long ago. And if you want a glimpse behind the veil of what other secrets high net worth individuals might be hiding, check out my Success Secrets of Wealthy Individuals video, where I spilled the beans on everything from Ivy League schools to John D. Rockefeller and the lessons that you can learn from these individuals and how to apply them to your own life. Thanks for tuning in, and I'll catch you guys next time.